Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Liz Clayman. Anthony Scaramucci will be back next week. We've got earnings season coming to an end, and the results so far are kind of nothing to write home about. It appears we are on track for the fourth straight quarter of declining profits for corporations.
Yes, companies are still making money, just less than they were before. So the question is, can the markets keep climbing while quarterly earnings keep falling? Joining us today, Bob Dahl, Nuveen Asset Management Senior Portfolio Manager and Chief Equity Strategist, and Troy Gayeski, SkyBridge Capital Partner and Senior Portfolio Manager. Guys, great to have you here. Good to talk markets. I think we've got a lot to talk about today. Bob, I want to start with you. We've chatted markets for 30 years. Why does it feel to me a little bit like 1999 or 2007, where we know that stocks are going up and we understand that the market's going up, but we kind of worry in the back of our minds that this is going to end pretty ugly?
I think there are two differences, Gary. One, interest rates then were here, interest rates then here down at low levels, which allows valuations to be higher. Number two, back to your earnings comment, we cannot get an appreciable higher stock market unless earnings do better. The quarter we're just about finished reporting is going to be again, but it's the last quarter. I think the third and the fourth quarters will have marginally up earnings. Will it be enough? Only time will tell. Without it, the market can't go up.
The bar was so low. I mean, when you think about how low the bar was for corporations to hit it, they are, if they're just scaling slightly above it, Troy, don't you think that that's interesting? And every bull market needs continued catalysts to go on and on. What are the catalysts going forward?
Well, for in the short term, it's just been central bank policy. I mean, if you look at what's happened to markets this year, it's really been because global yields are so low. There's the expectation that the Fed is not hiking anytime soon. And so in the short term, that's been driving stocks higher. But to Bob's point, unless you see earnings fall through the next several quarters, you know, that's where maybe this mini bubble could get corrected, because markets are dependent upon earnings growth the next 2 quarters. If not, we'll see an ugly correction.
So let's go back to interest rates for a second, because you were making the comparison, or the fact that we're in a different interest rate environment than we were in 2007. But the fact that rates are so low, if we don't get earnings, if we don't see growth in the economy, what happens then? Because we're not going to get the multiple expansion with rates where they are, or will we?
I don't think we will. Look, we just had the Brexit scare over the last couple of months, and that was a gift to the U.S. stock market, because the interest rate structure of the world went down another notch, enabling P's to go up another notch.
Right.
I can't look you in the face and say rates are going down some more. Maybe they will, and maybe P's will go up, but I think that ball game is, you know, in the extra innings. So we need the earnings. Where I think both are saying without the earnings, the market can't go up. But I want to come back to, we had an earnings recession. It's over. And we're going to get modestly better earnings going forward.
Do you think it's interesting? I'm glad you brought that up, because Brexit has only been mentioned in 40% of the conference calls for earnings in companies like that. They're not really talking too much, or at least blaming it. Does that mean, yay, we got through it, we skated through it? Or does that also mean we haven't fully seen the long part of this tail of what could be a hidden negative?
Well, yeah, I mean, the biggest negative from Brexit over the longer term, which markets aren't pricing at all, is the potential for the dissolution of the Eurozone, right? I mean, that was a big issue back in 2011, 2012.
Are we through it? I mean...
Well, again, once you have one country leave, if they leave successfully, and then places like Spain or Italy start saying, hey, maybe we should get out of this as well, then we can run our own monetary policy. But markets are ignoring that now, because to Bob's point, they're seeing hyper-loose monetary policy. There's nowhere else to go other than some complex instruments we'll talk about in a bit. And so in general, over the next several years, how the Eurozone resolves itself politically will be very important.
We did not have Armageddon with Brexit. But we don't know, what does Brexit mean?
So to your point, Liz, the companies aren't seeing the impact yet, because the economy over there hasn't seen the impact. But certainly, you had a warning flag. But what happens? More QE, stock prices go up.
Can I push you on this, Bob? Because Bob has now said twice in these couple of minutes, we're through the earnings recession. Why do you say that? Tell us why we should believe that.
There were 2 reasons earnings went down. Oil prices down and the dollar up.
Oil is still down.
Oil's down. It's not down like it was, and it's not careening lower where the bank balance sheets are being worried about. Now, if we resume the acceleration of the downside, we'd have to have another conversation. But look, we went from 30 to 50 pretty quickly, and we're correcting back to 40. I think oil will be between 30 and 60 for years to come. Oil has never made a V bottom. After a waterfall decline, it goes into a multi-year base building process at a low level. So I think oil will come and oil will go, but I don't think it's the issue.
Bob, you've seen a correlation. We've just finished the 2 conventions, and you think there has been an impact in terms of what the polls are saying with the election and what the market is. Share that with us.
Yeah, so if you look at the head-to-head polls that have been around for a bunch of months now, when Hillary Clinton moves up in the polls, the market goes up, and when Trump moves up in the polls, the markets go down. I think what the market's saying is, we may or may not like Hillary Clinton, but at least we know what she is. And I am, as the market, like certainty. I don't like uncertainty. With Donald Trump, there's just so much uncertainty. Is he really going to do a trade war with China and Mexico, et cetera, et cetera? So I think that's where we are. If Trump can get his act together and define what he will do, maybe the markets will react differently, but I think that's the rear view look in the mirror.
So the market actually likes the idea that they would rather know that there's higher taxes, less economic growth. I mean, does that make any sense? Troy, does that make any sense?
Markets hate uncertainty.
I think it's very simple. To Bob's point, it's the devil you know versus an unknown, right? And with Hillary, you know you're going to get 1 to 2% growth as far as the eye can see. Yep. With Trump, at least you have a chance if he embraces pro-growth reforms on taxes, on regulation, where we could get 3% growth, which would drive revenue, which would drive earnings.
And we should end by saying that one of the top economists, Martin Feldstein, said this week on Fox Business that the economy isn't that bad. So who knows? And he's a Reagan-era
economist. All right, guys, Bob and Troy, stay there. We'll be right back. Wall Street Week, back in a moment.